Hi everybody, Dr. Wright here. So in class we've been talking about how you calculate portfolio expected return and standard deviation using past or historical data, and specifically when we're talking about combining risky assets in a portfolio. Remember, we began by combining one risky asset with one riskless asset. It turned out that the math, especially for calculating portfolio standard deviation, was very straightforward in that simple case. However, what we want to turn our attention to now is what happens when we actually combine risky assets into a portfolio. So today, and I only want to do this in the two asset case, the math gets very unwieldy when you start adding more than two assets to the portfolio. So we're going to start with the simple case of two risky assets. We want to figure out portfolio expected return and standard deviation, and then we'll try to optimize that two asset portfolio. Now, I will tell you up front, very few people ever create portfolios of just two assets, and so what we're doing today is meant to be simply a launching point or a stepping stone for us to more advanced topics on the subject. However, the math, when it comes to adding more than two risky assets, requires that we get into matrix algebra, which is not something that most people in the class have the background in. So, we begin with two risky assets just to demonstrate the principles. So what I want to do is download data on two risky assets, and we'll form a portfolio, and we'll create the or calculate the portfolio expected return and standard deviation, and then we'll try to optimize the portfolio to create both the minimum variance portfolio, the maximum return portfolio, and then the maximum Sharpe ratio portfolio. So the two assets that I'm going to download is going to be the Vanguard 500 Index Fund, the VFINX fund. So VFINX. So this is just a passively managed S&P 500 index fund that has a very low expense ratio. It's a very good option for people just looking for low cost diversification. What I want to do is go and grab some historical prices, and I'm going to start with December 1st of 1989, and I'm going to take it through January 1st of 2011, which will give us a good 20 years worth of data, and we'll do monthly prices. I'm going to come down here to the bottom. I'm going to download it to a spreadsheet. Obviously, everything we're going to do is going to be in Excel. Pull that up, and so I'll just label this VFINX right there. And then the other fund that I want to get is VWESX. You can see that this is a long-term investment grade bond fund. So this is a bond fund that invests in long-term bonds that are investment grade, so those are very low risk, low default risk bonds at least. Let's go ahead and get the exact same historical prices on that. I could have shortcutted this, but we're okay. So December 1st, 1989 to January 1st of 2011. Again, monthly prices, get the data, and down at the bottom, download it to a spreadsheet. Pull that up, and I'm just going to copy and paste all these prices over to my other spreadsheet where I already have VFINX, and so we'll label this VWESX and just make sure that it looks right, and it does. So okay, we have about 20 years worth of monthly data for both the Vanguard 500 Index Fund and this long-term investment grade bond fund. Having that, I don't need this other file where I downloaded the bond data. I can get rid of that file, and we'll just work with everything here. Excuse me while I save this very quickly, and I'm going to save it as an Excel file. Notice that it would originally save it as a comma separated file. I want to save it as an Excel file, so I'll do that. And again, you can see I'm changing the file type to be an Excel workbook. Okay, once we've done that, we're ready to go. The first thing that we want to do is we want to resort the data from oldest to newest. It's customary to do this, so I'm highlighting all of the data, hitting Alt-DS, which brings up my sort wizard, and I'm just going to sort based on date from oldest to newest, like so. And then the next thing I want to do is calculate returns. So I'm going to calculate the return to VFINX, and then I'll calculate the return to VWESX, and if you want, feel free to format that just a little bit. I like to do that. Same thing here. And let's calculate the returns. Now, we've also been talking in class about how when assets are continuously traded, then we should use continuously compounded returns. And the way to do that is to just take the natural log of today's price divided by the previous day's price, or I should say previous month's price. And so we do that, and that gives us the continuously compounded monthly return for VFINX. We can copy and paste that over. That gives us the continuously compounded monthly returns for our bond fund, and we can turn that into percents, give it a couple of decimal places, center it. I suppose we could center all of this data if we wanted to, and we could also hide everything except for the returns at this point, so we'll just do that. So we have our continuously compounded monthly returns for the Vanguard 500 index. We have our continuously compounded monthly returns for our bond fund as well. And the first thing we want to do is just get some summary statistics on this. So I'm going to go ahead and go like this, VFINX and VWESX. Let's get the mean. Let's get the annualized mean. Let's get the standard deviation. Let's get the annualized standard deviation. So let's start out with that. So to get the average, we're just going to take the average of all of the continuously compounded monthly returns. Perfect. We can copy and paste that over. Remember to annualize this, since we're using continuously compounded returns, the annualization is very simple. All we have to do is multiply the monthly return by 12, copy and paste that over, and then we also want to copy and paste the formatting, right? So paste special T, and again, feel free to center all of this. So interestingly enough, and this is one of the things that I wanted to pull out from today's assignment, is over the last 20 years, the S&P 500 has generated an annual return. These are continuously compounded returns. So the Vanguard 500 index fund, which is just investing people in the Standard & Poor's 500 index, has returned about 8.08%. Again, that's continuously compounded annual return. Conversely, this Vanguard long-term investment grade bond fund has returned a total return of 7.75%. Again, that's also continuously compounded annual return. So actually very similar. Let's do standard deviation very quickly. And I'm also here going to do standard deviation of a population. Remember, when you're doing standard deviation in the denominator, you divide by n, the number of observations. If you're calculating population standard deviation, you divide by n minus 1 when you're calculating the standard deviation of a sample. I'm going to go ahead and do the population standard deviation. Honestly, when you get a big enough sample, it really shouldn't make a big difference. So there is that, and we can copy and paste that over. And again, let's copy and paste just the formatting, paste special T, and let's annualize the standard deviations. Remember, to annualize the standard deviation, we take the monthly standard deviation and multiply it by the square root of 12. Like so, and again, copy and paste formatting. So we get a very interesting outcome, and let's talk about this for just a second before we move forward at all. So the Vanguard 500 Index Fund has generated an average annual continuously compounded return of 8.08% with an annualized standard deviation of 15.33. The bond fund, on the other hand, has generated an annualized continuously compounded return on average of 7.75% with a corresponding standard deviation of 8.33%. So the bond fund has generated slightly lower returns but a much less standard deviation. Now, I don't want anybody to exit this class or this assignment thinking that bond funds are clearly superior to stock funds. It just so happens that over this 20-year period where we actually had two major crashes in the stock market, over that 20-year period, bonds have looked very, very good relative to stocks. That does not mean it will hold in the future. If you look at a longer history, you would see stocks vastly outperforming bonds. However, this relationship will hold. You will see that stocks reliably have much higher standard deviations than bonds. Well, what we want to do is we want to create a portfolio. So let's weight this up, and we'll start with a 50-50 portfolio. So let's turn those into percents and center it. And the next thing that we're going to need is we're going to need correlation and covariance. Actually, let's start with covariance, and then we'll do correlation. And I'm going to calculate it over here so that we don't associate these measures with any one fund, because this is actually a measure of the co-movement between the two funds. So we can actually use the covariance of a population function, which I'm going to do. And I'm going to highlight the first set of returns, comma, and then give it the second set of returns, close it up, and we get our covariance. And why don't we just put portfolio right here. Now remember, covariance is very difficult to work with because the covariance is actually a squared measure, and so it would technically be percent squared, which is very, very hard to interpret, which is why we often use correlation. So correlation, and let's highlight the first array and highlight the second array. And now that is something that we can interpret. It gives us something that we can work with. Remember that correlation is bound by -1 and 1. Correlation of 1 would mean perfect positive correlation, meaning the returns would move perfectly in unison. Correlation of -1 would mean perfect inverse correlation, meaning that the return series would move perfectly opposite of one another. Correlation of 0 means that there's no correlation. The way to interpret that is, as one series moves, we have no idea what the other series is going to do. It could move in tandem, it could move in opposite, or it could move flat. Getting a correlation of 0.217 is actually relatively low. What that tells us is there are going to be some significant diversification gains to be had by putting these two assets together in a portfolio. Now, let me just remind you of some of the things you've seen in class. So in class, we talked about how you actually calculate portfolio expected return and portfolio standard deviation. Let's start with portfolio expected return. Portfolio expected return is actually very easy. Whenever you have return to asset A and return to asset B, and you have the weight on asset A and the weight on asset B, all you have to do is take the weighted average of those two expected returns, and you'll have the portfolio expected return. One little side note, remember, portfolio expected return is what we think the return will be in the future. What we're doing right now is using past returns in order to estimate or infer expected returns. That can be a treacherous prospect, so just be warned that when you use past returns to calculate expected returns, you could be significantly off. Nevertheless, we're going to go ahead and use the methodology. So we'll just take the weighted average to get portfolio expected return, and I'm not going to worry about monthly returns and monthly standard deviation. We're just going to care about annualized data here. So to get the annualized mean, what we'll do is we'll take VFIN-X, expected return each year, 8.08%, and multiply it by its respective weight, and then we will add the bond fund expected return times its respective weight. And again, we don't really want it to look that ugly, so let's just give it a couple decimals, center it. We can do this. That probably doesn't need nearly as many decimals as well, so just clean it up a little bit of formatting here. But you can see if we do a 50-50 portfolio, then we're going to have a portfolio expected return of 7.92%, which is no surprise since it's going to be directly in the middle of those two expected returns, since the expected return has nothing to do with co-movement and it's just the weighted average. So no surprise that if we do a 50-50 portfolio, then our expected return is going to be right in between the expected returns of the two assets. All right, let's talk portfolio standard deviation. So portfolio standard deviation is technically calculated this way. For a two-asset portfolio, it translates into this right here. So we take the square root of the weight of the first asset squared times the variance of the first asset, plus the weight of the second asset squared times the variance of the second asset, plus 2 times the weight on the first asset times the weight on the second asset times the covariance. Conversely, you can replace covariance with correlation multiplied by the product of the standard deviations. The reason for that is correlation is the covariance over the product of the standard deviations. So if you multiply this by the product of the standard deviations, you're just left with covariance. Hence, we can replace covariance with the correlation times the product of the standard deviations. Either way works. It doesn't matter to me which way you choose. Okay, so let's calculate portfolio standard deviation using either of those two formulas. So it's going to be the square root of, first off, the weight squared of the first asset times the variance, which is the standard deviation, squared. Then we need the weight of the second asset squared times the variance of that asset, which is the standard deviation squared, plus the 2 times the weight of the first asset times the weight of the second asset times, and I'm going to use covariance, But remember, you could use, instead of covariance, you could use correlation times the product of the standard deviations. Either way would work. And we'll give it a little bit of formatting TLC and center it. Okay, and then let's just format everything a little bit here just to make it readable. And by now you know that I like to do this just to make it sharp, make things pop a little bit. Okay, now what I want to do is calculate the Sharpe ratio, just to do some comparisons. So let's calculate the Sharpe ratio over here, which is going to be our mean divided by our standard deviation. And do it over here. And again, just giving it some formatting TLC, paste special T, minimizing this. Now, keep in mind when you do the Sharpe ratio, typically the Sharpe ratio would be the annualized return minus the risk-free rate over the standard deviation. I'm kind of doing a back-of-the-envelope version, which is just the raw return over the standard deviation. Okay, so notice Sharpe ratio for the VFINX was 0.53, for the bond portfolio was 0.93, and for the bond fund, I should say, 0.93, and for our overall portfolio, 0.9. So the real question here is, so this is basically in a nutshell what I want you to be able to do. But what we want to be able to do is we want to discover whether or not we can increase our Sharpe ratio and get a better Sharpe ratio in the portfolio than we could get with either of the assets. Now, right now, you can see that the bond fund actually is superior or preferred to our portfolio. Are there weightings, however, that could make it so that our portfolio of the two assets combined exceeds that 0.93? Well, we can take a stab at it and make guesses. I mean, I'm guessing if we did 85 and 15, yeah, you can see that we start to get some real significant diversification benefits here. But I'd like to get more precise than that. So let's do this. Let's do a let's do a min variance portfolio, and let's do a max Sharpe ratio portfolio. Okay, so what I want to do is use the solver function to try to first off minimize the variance of the portfolio and then maximize the Sharpe ratio of the portfolio. Before I do that, I'm going to need a variable right here. I'm going to need this as one of the constraints in my solver function, so let me just put that right there for now. Okay, so let's pull up our solver function. And the first thing I want to do, and let me clear all this out. So what I want to do first off is minimum variance portfolio. So I want to take this annualized standard deviation of the portfolio and minimize it by changing the weights in my portfolio, subject to the constraint that the portfolio weights have to equal 1. But also I'm going to put a no short selling constraint. So I'm going to say that both of those cells have to be greater than or equal to 1. Or I should say 0. No short selling. Okay. Click solve, let it do its thing. Click OK. And you can see that the minimum variance portfolio is a weight of 22% and 78%. And we could get even a little bit more precise with that if we gave it 1 or 2 more decimals. So 22.4 and 77.6. That's our minimum variance portfolio, and what do we get for the variance on that? Well, we get this, and I'll just paste special V so we keep it. All right, now what I want to do is I want to maximize the Sharpe ratio. So let's do this one more time. Data, solver, let's reset everything. And now what I want to do is I want to take this Sharpe ratio, I want to maximize it by changing the weights. Again, let's add in the constraint that our total portfolio weights have to equal 1. And let's add the constraint that we can't have any short sales, so those weights have to be at or above, have to be equal to or above 0. Click OK. Hit the solver function, see what it does, and now we get weights like so. And we get a Sharpe ratio of that. And we'll center it. And we'll just make a note that that's the minimum variance, that's the maximum Sharpe ratio, and we'll highlight it. Okay, let's just make a few points here. First off, one of the true benefits of diversification is that you can lower your risk. And you can see that this bond fund by itself has a very low standard deviation. That's an exceptionally low standard deviation, considering that the average annual return has been 7.75%. But by adding even just a little bit of the stock fund to it, we can actually lower that variance or the standard deviation by an entire percent. I should label that minimum standard deviation. So you can see we took the standard deviation of the bond portfolio, which was 8.33%, by mixing in some of the VFIN-X. We got our portfolio standard deviation down to 7.37%. On the Sharpe ratio, you can see that the bond fund also had a very impressive Sharpe ratio of 0.93, which was clearly superior to the VFIN-X. But by mixing in a little bit of the stocks again, we could get the Sharpe ratio up to 1.06, which is considerably higher than anything we could do with the assets by themselves. Let me do one last demonstration. I just want to show you that this portfolio is superior to anything we can do by itself. And this is how I'm going to show it to you. Data, Solver. Let's reset everything. And this is what I'm going to do. I'm going to minimize the variance. Okay. So I'm going to minimize the standard deviation of our portfolio by changing the weights. But now I'm going to put several constraints in. First off, I'm going to put in the constraint that we've had before, that the portfolio weights have to equal 1. I'm also going to put in the no short selling constraint. But I'm going to add one more. I'm going to say that our portfolio expected return has to be greater than or equal to whatever the bond fund is doing. So I want to see if we can get the bond fund's expected return but get a lower standard deviation. Click OK. Let the solver do its thing. Okay. And you can see in our portfolio, if we have weights of 22.4 and 77.6, which actually happens to be our minimum variance portfolio, you can see that we're actually generating an annualized average return that's 7.83% compared to 7.75% for the bond portfolio, and yet we've dropped the standard deviation by almost a whole percent. So we're getting a higher return and a lower standard deviation. So just demonstrating the power of diversification. Now keep in mind, you will get more powerful results from diversification when you have two things. First off, the lower the correlation, the more powerful the results will be from diversification. And second off, the better the Sharpe ratios of the individual assets going into it, the more powerful the benefits will be from diversification. Hope this assignment's clear. I want to reiterate this is a very simplistic case. It's only 2 assets. If we wanted to increase the number of assets in the portfolio, we would have to utilize matrix algebra, which is something that we're not equipped to do yet in the class. If you have any questions, feel free to contact me or the TAs. We're very happy to help. Good luck.